With the first management now, it was a mixed quarter for Cera Sanitaryware. Company's revenue growth for Q2 was muted, although there was margin expansion year-on-year basis. Stock is down 11% from its highs. Let's get in the management. Ayush Bagla, who's the Executive Director at the company, joining us now to discuss the earnings outlook as well. Ayush, good afternoon. Thanks a lot for joining us. Well, I wanted to understand about the outlook going forward. Your faucet capacity was to expand 2.5 times. How much of it has already happened, and what's the utilization? Additionally, what is the current share of revenues from faucets for you?
Thank you for having Cera Sanitaryware on your show. We had our best Q2 ever in the history of the company. And faucetware, the current plant is operating at 116% capacity. The demand far outstrips current production. So we did a lot of in-house moves to raise our productivity levels. We are making about almost 3 lakh pieces per month. That is being raised to 4 lakh pieces per month. And the capex has already commenced. Capex is about 69 crores, which will get completed by July 23.
And as far as the revenue of your different segments, all the segments, can you tell us, how much came in from sanitaryware this time? How did that vertical perform? Tiles, faucets, all of them, if you could give us a sense of the breakup of these revenues as well as margins.
Cera is primarily a sanitaryware company. 55% of its top line is from sanitaryware, about 33-34% is from faucetware. Wellness is about 2%, and tiles is about 19%. So 88% of our top line is from our core two categories of sanitaryware and faucetware, which are also the most profitable.
Right.
Okay, go ahead.
And what was the margin breakup across these segments? Just wanted to understand primarily because, the last time you joined us, you did say that the raw material prices inflated by much higher than the price hikes that you took. Now that we've seen some cool off in important inputs like both brass and gas, can you tell us what do you have in terms of margin outlook for this year?
We explained that our best case is that margins go up by about 75 basis per year on an annualized basis, and we are far exceeding that number currently. So the margin profile at the EBITDA level was always in that 12-13% category. This quarter, we've achieved almost 15.94%. And on an annualized basis, a similar margin is definitely possible. So as top line has grown from 1220 crores to 1440 last year, and this year the same trajectory can be expected. So the EBITDA margin should be upwards of 15%.
Okay, EBITDA margin should be upward of 15%. Can I probe you a little bit in terms of what you could do in terms of total revenue? Because in the first half, you've already done over 800 odd crores. Last year in FY22, you did over 1400 odd crores. Are you poised to probably double this revenue that you've done in the first half in the second half as well? And hence we're assuming maybe over 1600 crores in terms of total sales for the fiscal. Is that a fair assumption?
The second H2 has about 55% of our total revenues. So based on that, we should comfortably cross your number. But we are very careful before giving out any guidance.
Okay. But if you could just give us a sense in terms of how demand is doing, because you did say you have some capex which is coming on stream as well. Give us a sense in terms of segment-wise capex, segment-wise demand, as well as what your assumption would be in terms of growth drivers as well, probably in the next year odd.
First of all, we are completely a B2C focused company. Sanitaryware and faucetware, home improvement, home upgradation are our major themes. So we have been very careful to steer away from interest rate sensitive such as new home loan sales and B2B businesses. So if you see the last 4 years trajectory, we have grown at 1.5 to 2 times the industry growth, both in faucetware and sanitaryware, which is 88% of our business. Going forward, that will continue to be the focus. Because of financial prudence, our cash in hand is now crossed 570 crores. Rating is AA by CARE and AA minus by CRISIL. We have 0 debt on our books, either on the working capital or on a term basis. We have not utilized our A1 plus rating for our commercial paper program. All the capex is being done from annual operating cash flow, both the 69 crores for faucetware and the proposed 129 crores for sanitaryware. And on the margins, these two are the high margin businesses, and their growth, because of the nature of the industry, is so moated. The top four players continue to have more than 60-65% market share in sanitaryware, and we are the largest player in sanitaryware and the second largest in faucetware in the country right.
Ayush, just to follow up on the margin number, you had earlier indicating margins will be between 17 to 19%. Now you're saying it will be upwards of 15%. Are you lowering your guidance there?
The sanitaryware and faucetware business have a higher margin than the blended margin for the company. And on a particular quarter, including other income, just because of the size of treasury, you might get an upward spike. But on an annualized basis, a 15 plus number is the number we would like to have. And that margin growth was achieved both last year and the first 2 quarters of this year.
570 crores in terms of cash is what you have. Ayush, what do you plan to do with that for your investors? I mean, the capex that you have is just a little over 120 odd crores at best. The remainder, do you plan to give it out as, some dividends or maybe a buyback as well?
Actually, there's no discussion of a buyback on the table, Mangalam, but last year was the 40th year for the company, and there was a special dividend declared. So 46 crores was the dividend outgo. A novel dividend outgo annually has been around 20 crores. So being a financially very conservative company, we'd like to take very calibrated steps in that direction.
Okay. Any acquisitions which you would consider?
So we'd be very ready to consider any kind of acquisition in the sanitaryware business to acquire not a brand, but capacity. Because we feel that despite all the debottlenecking and expansion activities that we are currently undergoing, it's a matter of time that the company outgrows its current capacity.
Just quickly, before we let you go, have you shifted from gas to propane? What's your fuel mix there?
Currently, we are on natural gas, and there's a reason for that. We have access to gas from Gas Authority of India in the district of Mehsana, which is at about 40-45% discount to market prices, because these are from isolated wells in and around the factory, which are not connected to the national grid. So that is an inherent advantage of about 30-35 crores in costing that we get. Our gas cost till last year was about 13 rupees. Now it's about 25 rupees. In October, it's gone up to 33 rupees, compared to 75 to 80 rupees for the rest of the industry.
Okay. All right. So higher gas costs is definitely plaguing multiple industries across the board. But thanks very much for joining in and speaking to us. So that's Cera Sanitaryware. The stock is down around 4%, but they are positive in terms of growth as well as in terms of margins. It's definitely a play on the domestic growth story. And it is a cash-rich company with over 500 crores of cash on books. We need to take a short break. But up next, we'll be speaking to Vinati Saraf Mutreja, who's the MD at Vinati Organics, that company in focus on account of its Q2 numbers as well. Stay tuned.